Hello, good morning everyone. Welcome to Phillip Securities Research Morning Call for 11th of November 2024. For today, we have quite a few stock counter updates, and as usual, we would end the session with Singapore Weekly. So kindly note that Zain would be on leave today, so there would be no TA session. This is just a gentle disclaimer that the webinar is just for educational purposes. So without further ado, let's get started with Microsoft's first quarter 2025 results. So overall, the results were in line with our expectations, with first quarter revenue and PATMI coming in at 24% of our full year forecasts. In terms of performance, the total revenue, it grew by about 16% on a year-over-year basis, and this was 1 percentage point ahead of its top end of the company's guidance range, mainly driven by a strong demand for its cloud solutions and AI-enabled services. So, moving on to the positives, the Azure revenue, it grew by about 34% on a year-over-year basis as compared to the company's guidance of 33% growth expectations. And this beat was mainly because more a number of workloads, they were migrated from on-premise to the cloud, and the company, it also witnessed increased demand for its Azure AI services. So these services, they basically help its customers or companies to integrate generative AI across their products. Like for instance, they help with tools like summarization or incorporate chatbots into their websites. So it witnessed increased demand for its services. Secondly, the Office 365 commercial cloud revenue, it grew by about 60% on a year-over-year basis, and this was also higher as compared to the company's expectation of 15% growth rate. And this was mainly driven by the expansion of its number of users by about 8% year-over-year, and also it witnessed a higher average revenue per user, mainly because of the customers, they migrating to a better E5 licensed software for better advanced capabilities, and also it was witnessed increased adoption of its Office 365 Copilot tools, for instance, in the presentation, it can generate first draft of the slides and summarize or generate text into the word. So it was witnessed increased adoption of these tools. In terms of negatives for Microsoft, gross profit margin, it dropped by about 200 basis points, and operating margin dropped by about 100 basis points. And we believe that this could mainly because of the significant jump in its capital expenditures, which jumped by about 50% on a year-over-year basis, mainly because it continued to spend into its cloud and AI related build out infrastructures. In terms of outlook for the second quarter, the company expects revenue growth rate to grow by about 11% on a year-over-year basis. And this should be continued to be driven by its Azure platform, which is expected to grow by about 31.5% at the midpoint. So sequentially, there is a drop of about 250 basis point, and this is mainly because of capacity constraints. And management also highlighted that it's some of the deliveries, third-party deliveries, they were pushed forward into the second half of 2025, and as a result it's forecasting a lower growth rate in the second quarter. But it remained positive that as the capacity increases, it should lead to a higher revenue growth rate, or the revenue growth rate should accelerate in the second half of 2025. Whereas for the first time, management highlighted with respect to its monetization of AI investments. So it highlighted that by the end of 2024, on an annual basis, the AI revenues should contribute to about 10 billion US dollars on an annual basis. So it's still at the early stage, as it represents about 3 or 4% of its total revenue. Whereas in terms of margins, they are expected to remain flat at 44%, despite a sequential increase of its capital expenditures. So moving on to the valuations, we maintain our accumulate recommendation with the unchanged target price of $480, mainly because there are no changes to our forecasts. So overall, for Microsoft, we believe that it should continue to it's well positioned to benefit from strong demand for the large language models, which should enhance its Azure's capabilities, and also the incremental revenue from its Copilot tools, it should help to benefit or boost its top line in 2025. So that's all for me. I would now like to pass it on to Jonathan.
Yeah, thanks, Amrish, and good morning, everyone. So I'll be running through Meta's third quarter results. Next slide, please. Yeah, so overall, third quarter results for Meta were actually pretty good, outperforming on both top and bottom lines. Their 40 plus billion in revenue was at the top end of their own guidance, so very positive there. At the same time, net margins grew about 5 percentage points year on year, to reach its essentially its highest levels since the third quarter of 2017. Very significant work done on both the revenue line as well as the margins. And this comes even though they increased headcount by about 9%. So the main positives are really revolving around AI. I think AI continues to demonstrate, or rather Meta continues to demonstrate their ability in leveraging AI on two fronts. So the first front would be to find more opportunities for monetization. At the same time, they're also improving their own systems, improving their advertising capabilities to deliver a higher ROI for advertisers. Something interesting is that they developed this new modeling and learning system where it tracks essentially user behavior before and after viewing a particular advertisement, and then just models it just essentially to track your behavior and to what they use this for essentially is just to collect more data so that they're able to better present advertisements at particular spots in a user's viewing history. And then on the second front, they're actually internalizing a lot of generative AI technology, particularly for coding as well as for content moderation. So helping them is essentially be more efficient internally and saving a lot of costs over there and a lot of time. So similar to net margins, operating margins are also the highest since the third quarter of 2017 at about 43%. So significant margin gains there. The main negative for Meta comes from their Reality Labs segment, which is their metaverse segment. It's still quite an unknown. They're still losing a lot of money, about 4 to 5 billion every quarter. They're on track for a 18 to 20 billion loss run rate over the next 12 months, or rather over the previous 12 months. And that's really just dragging overall growth down for the company. At the same time, it weighs about 11 percentage points on total operating margin. So essentially, if they didn't have their Reality Labs segment, their operating margin would be about 54-55%. So very significant drag on margins as well. The commentary from Meta is for even more losses to continue for the foreseeable future. And this comes as they continue to spend, to invest heavily there, as well as they aren't really seeing any output in terms of revenue. It's just spending without really seeing anything significant. You can see, I think they only gain less than 300 million in revenue for the quarter, so basically nothing. And we expect this to remain the case until there are some tangible monetization opportunities there. In terms of the outlook, the key thing is that they raised 2025, or rather the commentary was for a further step up in 2025 capex. So for 2024, they're on track for about 40 billion, which is about 40% year-on-year increase. And for next year, they didn't give a exact figure, but roughly from the commentary, you expect about 20 to 30% increase year-on-year. So still significant investing, especially in AI infrastructure, in their AI GPUs, and so on. Overall, we still think that Meta is the leader in AI, similar to Google. They demonstrated, over the last few months and last few quarters actually, that they have this ability to leverage AI into its core advertising business. We do also see quite a bit of more monetization opportunities with some of their newer products like Meta AI, Threads, as well as business messaging. In terms of valuations, we maintain an accumulate rating, but we raised our target price to $640, mainly because we raised our 2024 revenue and PATMI by 2% and 14% respectively. So that's all for Meta. I'll move on to my next counter, which is AMD. AMD also announced their third quarter results last week. Revenue was roughly in line, while PATMI actually missed on higher expenses. the main positives for AMD are also, I guess, surrounding AI to a large extent. They're seeing very strong momentum across their MI300X accelerator, which is very comparable to NVIDIA's H100 and H200 series. And we can see, in the red box over here, they roughly had about 1.5 billion in revenue, so it makes up about 45% of total data center revenue. But more importantly, on a quarter-on-quarter basis, this number was up about 50 to 55%, we estimate. It just shows that they continue to ramp their supply chain fairly well. And because similar to NVIDIA, they are not demand constrained, they have way too much demand. So the ability to ramp supply is key to growing data center revenue and their accelerated revenue. Aside from their AI GPUs, on the traditional server CPU side, as well as for their PC CPU and GPU, they're also gaining market share on Intel, which is quite significant. I mean, Intel has been the main dominant players in these spaces for the last 20, 30 years, especially in PC. But what we're seeing right now with superior benchmark performances, especially of their new Ryzen 9000 series versus Intel's Core Ultra, we are seeing quite a bit of market share gains. About 25% market share is our estimate for the third quarter of this year versus about 20% in the third quarter of last year. So about 5% market share gains. We expect this to continue moving forward, especially because they have proven that at least in the PC side, they continue to be comparable and even slightly better in terms of value versus Intel. On the server CPU side, it's a similar story. It also helps that they have a very competent AI accelerator product, which they can pair with their traditional server CPUs. In terms of the negatives, it's the same story that has plagued AMD over the last few quarters. Gaming, which is their console business of PS5, Xbox, remains a huge drag. It's down 70% year on year, which is a significant drop. At the same time, the embedded segment, which is chips that are put in in some industrial machines, in automotive machines, and so on, were also down about 25% year on year. And so these two were just big drags on overall growth. Embedded in particular is very important because the margins that come from the embedded segments are typically higher than corporate average, even higher than their data center business currently. So a slower recovery would just put a little bit more pressure on margins. In terms of our outlook, we still are quite positive on AMD, especially for their server and PC CPU and GPUs. We think that they'll continue to gain market share on Intel. And on the AI GPU side, the new MI300 325X is starting to ramp well as demand picks up, similar to NVIDIA's new Blackwell. The caveat here is that the 325 is obviously not as powerful and doesn't have the same specs as the Blackwell GPU, but they are essentially at a fraction of the cost. So we think at least on the AI GPU side, they'll still be the little brother to NVIDIA, but they'll still be able to gain quite a bit of revenue growth from this area, especially with a lot of the tier 2 hyperscalers and other sovereign nations and other corporates. In terms of our valuation, we maintain buy, but we actually lower our target price to $170. We cut our 2024 PATMI by 25% due to higher expenses as well as a slow recovery in the embedded segments. So that's all for AMD, and for myself, I'll hand it over to Helena for the rest. Thank you.
Thank you, John. So I'll be sharing the fourth quarter earning for Apple. Next slide, please. Their fourth quarter earning was actually pretty decent. Revenue was within our expectation, and PATMI missed. This is because of the one-time income tax expense of $10 billion to the Irish government under the EU regulation. So iPhone performance was the highlight of this quarter. It was up 5.5% year on year. Moving to the positives, the first we think services has been consistently very strong. Services, they have a significantly higher gross margin compared to hardware, which is 74% versus 35.3%. So it has been a key driver of growth and margin expansion. Over the past year, Apple has actually consistently achieved strong double-digit year-on-year growth in services every single quarter. So we do favor this segment because many subscriptions are actually recurring. And with Apple's expanding install base, this makes revenue growth highly predictable. So services now, they exceed 1 billion paid subscription, which is more than twice the count than 4 years ago. Second one, like I mentioned just now, iPhone sales beat street expectation by 1.6%. So this kind of signals very strong initial interest even ahead of the full rollout of Apple Intelligence. A similar trend can be seen in the adoption of iOS 18.1, which is Apple's first AI beta version, launching late October. So the iOS 18.1 is adopted at twice the rate of iOS 17.1, which is introduced same time last year. So we do anticipate increasing iPhone sales in FY25 and 26, fueled by strong interest and additional features for the rollout, including the ChatGPT integration and expanded regional availability in this December. Moving on to the negative, we think China still remains a risk. Apple's revenue in China have declined for the 5th consecutive quarter since the first quarter of FY23 because demand starts shifting towards local brands like Huawei. So to take a simple example, as a premium option, iPhone 16 Pro is priced at 7,999 RMB. So that's like 40% premium over Huawei's Mate 60 Pro. So the pricing gap we think is a little bit challenging for Apple, especially as consumers become more price conscious. And additionally, the rollout of Apple Intelligence in China is expected to be very slow or even not at all due to the stringent regulation and the ongoing US-China tension. In terms of outlooks, Apple expect the next quarter revenue to increase by low to mid-digit year-on-year. Services is expected to continue its double-digit growth, like FY24. We estimate iPhone sales to step up slightly to high-digit year-on-year growth, given the rollout of Apple Intelligence, while we expect iPad, Mac, and wearables to remain flat. Our outlook on Apple remains largely the same. The gradual rollout of Apple Intelligence may take time, but we're confident that eventually it will positively impact the iPhone replacement cycle in FY25 and 26. iPhone growth has been rather flat in the recent years. The latest peak we see was in FY21, where Apple sales grew 39% year-on-year. So we do believe a 3-year cycle is ideal for prompting consumers to consider upgrading. This combined with rising interest in Apple Intelligence, this should support long-term earning growth for Apple. We upgrade our recommendation from neutral to accumulate. Our FY25 forecast remains unchanged. We roll over an additional year of valuation and raise the DCF target price to $235. And so that's all for Apple. Now I'll also be sharing the third quarter earning for Amazon. Next slide, please. So also a very decent quarter. Their third quarter 24 revenue was in line with our expectation, and PAMI actually exceeded. It increased by 73% year-on-year due to continued cost reduction efforts, increasing profitability and contribution from AWS. So moving on to the positives, AWS maintained very solid growth. It grew 19.1% year-on-year in the last quarter, which is their largest revenue growth in the last 7 quarters. So this growth was largely fueled by consumers expanding their cloud presence to cut costs, boost innovation, and scale generative AI initiatives. Their operating margin rose almost 8% to 38.1%. This is driven by their cost control and extended server life. We expect AWS growth to accelerate as cloud migration still remains at a very early stage. The second positive point is their retail is actually pretty resilient despite pullback in consumer spending. This is because Amazon, they actually have a pretty continued focus on cost management, and this is supported by a better inventory placement system. And second, they also have a shift towards lower ASP products and essential categories in order to align with the changing consumer preference. And third, they have pretty strong advertisement growth, which is driven by sponsored products and Prime Video ads. And the last positive point we think is their margin has been consistently stronger over the past years, with operating margin increasing to 11% in the last quarter. So we believe there remains further potential for margin growth as the company continues to drive efficiencies in both AWS and retail. Only one point for negative, higher capex continues. So Amazon have guided for $75 billion capex for FY24, which is a 56% year-on-year increase. And up to now in the third quarter, they've already spent $50 billion. And they have also guided for even higher capex for FY25. So this is actually 15% higher than our previous estimate. So most of the spending will support AWS in meeting the robust growth. So this will definitely slightly weigh in on the near-term valuations. In terms of outlook, Amazon has guided the next quarter revenue to be around 7 to 11% year-on-year growth. And their operating income, they're a little bit not sure. So it's a really big gap. It's 21% to 51% year on year. We think Amazon's sustained strength in AWS and operating margin is definitely a significant positive. Their management has also confirmed that AWS currently face capacity constraints to generative AI usage. So that means the ongoing increase in CapEx investment is definitely a strong foundation for durable AWS growth in the coming years. On the retail side, we believe Amazon has also efficiently adapted to the new market trend while maintaining profitability. So in terms of valuation, we keep our FY24 revenue unchanged, but increase PEMI by 6% to reflect the improving efficiencies, lowered costs, and higher operating margins. We maintain our buy recommendation and raise our DCF target price to $240. So that's all for my sharing. I'll pass my time to my colleague Glenn.
Thanks, Helena. Yep. So for the banks, we have 3 of the Singapore banks. They all released their results in the same within 2 days, so Thursday and Friday. We'll start first with DBS. DBS's third quarter adjusted PATMI of 3.03 billion. They were above our estimates, mainly due to the higher fee income and trading income. So this is a similar sort of a story and storyline we'll see for across the board for the next 2 banks as well. That the trading income and fee income were rather high. So 9-month 24 adjusted PATMI for DBS was at 83% of our forecast, and the third quarter DPS rose 23% year on year to 54 cents. So, but it was flat quarter on quarter at 54 cents. Now jumping straight to the positives. First positive is the trading and wealth management income surged, and this is mainly due to the volatility during the yen carry trade in August, which contributed to the market's trading income reaching a 10-quarter high. So it was up 53%. For wealth management fees, there was also growth, mainly due to this continued shift from deposits into investments as well as bancassurance, and also due to this expansion in AUM from net new money inflows. For the second positive is that net interest income rose despite the NIM dipping 8 basis points year on year. So for DBS, they are quite different. They're quite significantly different from the other 2 banks in the sense where they have a lot of excess deposits where they can place it back into higher interest yielding, longer tenure kind of assets and gain better net interest income from this. So that's the reason why you see this net interest income growing. But because they are accretive to earnings, but they diluted NIM slightly, so we see the NIM dropping, but their net interest income increasing. And the last positive is that their allowances and credit costs have both improved. So their SPs and GPs have both fallen, and this is mainly due to this resulted in the credit cost improving by 4 basis points year on year. As for the negatives, there's only one negative, which is that their expenses have climbed up and it rose 10% year on year. But if you look at their cost to income ratio, it was stable year on year at 40%. So DBS expects this to be around this range for the rest of the year and in the low 40% range for FY25. As for the outlook, we believe that their capital is more than sufficient. Their CET1 ratio with the fully phased-in version has risen 40 basis points quarter on quarter to 15.2%. So this is still above their upper end of their target operating range. It's their target range is 12.5% to 13.5%. They have committed to the 24 cents per annum increase to the DPS. So they said that that was still maintained, and they have also announced this new share buyback program of $3 billion, which would reduce their fully phased-in CET1 by 80 basis points. But it will still be above their target operating range, right? They're looking around 14.4% CET1 after this share buyback program. So I think there's still some room for them to even give out more dividends or give some special dividends if they want to lower their CET1 further. For the fee income recovery, they have maintained their guidance for double-digit fee income for FY24, and they will expect this momentum will continue and for fee income to grow by 36% year on year in the fourth quarter of 2024. They've also provided some 2025 guidance, and they just mainly said that it will be high single digits, which will be led by wealth management fees. As for the net interest income and PATMI guidance, the FY24 one has not changed, but they did provide new guidance for FY25, and I think the key highlight here is that they will expect everything else will be rather stable, so NIM will be will be slightly reduced. Net interest income will be maintained. But I think the main highlight is that PATMI, the profit after earnings, will be expected to decline from the 2024 levels, and this is mainly due to the global minimum tax of 15%. So they said that this decline is mainly due to them having quite a lot of I think they have tax reliefs for certain revenue line items in Singapore. Hence, their average tax in Singapore is only around 12%. So this will increase it by 3 percentage points if it's everything is averaged at 15%. Yeah, but they did also give some assurance that their current dividend policy of the additional 24 cents per year will be maintained even if these earnings fall and their dividend payout ratio exceeds 50%. So that's another differentiator for DBS, where they do not cap themselves to a dividend payout ratio of 50%, unlike the other two banks. So we do maintain a neutral with a higher target price of $41.60 as we raise our FY24 earnings by 7%, mainly from the higher wealth management income, trading income, as well as lower provisions. We expect the fourth quarter PATMI to grow by 9% year-on-year from the stable growth in net interest income, as well as the double-digit fee and trading income, which will give the further boost to earnings. And last but not least, the steeper yield curve will also provide tailwinds, as they have another 55 billion Sing dollars of fixed assets, which will be repriced in FY25. Now moving on, so that's all for DBS. Now let me move to OCBC. Yeah, for OCBC, the third quarter earnings of 1.97 billion were also above our estimates, and this is again due to the surge in trading as well as their fees income. The 9-month PATMI was 81% of our FY24 forecast. Jumping straight to the positives, the first positive is that their trading has driven their non-interest income. So it also hit a new quarterly high, like DBS, of 508 million, and it was up 135%, mainly from higher customer flow income. And this was the main driver for non-interest income growth, which grew 41% year-on-year. The fees also grew, but of course at a slower pace, and this is mainly due to their wealth management AUM growth and continued net money inflows of 5 billion for the quarter. As for the second positive, the allowances were down 8% year-on-year. This was coming from the lower SPs of 37 million. However, their total credit cost for the quarter did rise by 5 basis points to 22 basis points. They have lowered, but they did lower their FY24 credit cost guidance to 20 basis points. From previously, the previous guidance was 20 to 25 basis points. So they're quite close to that number. As for the negatives, the net interest income inched down from the NIM compression of 1% of about 9 basis points year-on-year. So this was mainly due to higher funding costs, which lowered their NIM. For the second negative is that their expenses have continued to rise. So their OPEX, operating expenses, have risen by 9% due to higher expenses associated with their increased business volumes as well as IT-related expenses. But nonetheless, their cost-to-income ratio has improved to 38.5%. As for the outlook, we believe that their loans growth guidance of low single digit will be met. They had a 2% loans growth. And this, it will be mainly coming from the energy, power, and utility segments. And we expect loans growth to come in at around 3% for full year FY24. As for the fee income, their ongoing investments as well as the expansion in their wealth management franchise has led to the fee income growing by double digits. And we are expecting fee income growth of 12% for FY24, which could add around 216 million to their revenue. And we maintain accumulate, with a higher target price of $17 as we increase our FY24 earnings by 8% from higher trading income as well as lower provision estimates. We expect the fourth quarter earnings to grow by 21% year-on-year, and this is rather high because they are coming off a very low base in the fourth quarter of 2023. And this growth will come from the double-digit fee and trading income recovery, while the provisions will maintain stable. We like OCBC mainly due to the attractive valuations as well as their dividend yield of 5.4%, buffered by a very well capitalized 15.6% CET1. So this is what makes OCBC stand out from the other two banks, is that they have a very high CET1, 15.6%, and their target range of CET1, which they mentioned, is 14%. So they have about 160 basis points of excess capital, or if you put that into dollars, that is 4 billion Sing dollars. And they did not mention much about how they're going to return it to shareholders, but they did hint at doing something in the medium term. So medium term will be around 3 years, but we'll only provide more details in the upcoming results in the fourth quarter. So now that's all for OCBC. Let me move to the last one, which is UOB. Yep, give me a minute. So for UOB, their third quarter adjusted earnings were also slightly above our estimates, mainly due to the jump in the trading and investment income, as well as higher fee income. Their 9-month adjusted PATMI was at 76% of our forecast. For the positives, the main and biggest positive, again, is that their trading income has boosted their earnings from the higher volatility. And secondly, their fee income has also was supported by the wealth management, mainly from this recovery in lending activities and improved market sentiment, which resulted in the continuous recovery in wealth management fees. Their AUM also has grown by 9% year-on-year from net new money inflows of 4 billion for the quarter. The last positive is that their net interest income has inched up despite the NIM contraction. So it rose by 1% from loans growth of 2%, while the NIM contracted to 2.05%, which is a decline of 4 basis points year-on-year. So they managed to do this, different from DBS, is that they managed to do this by cutting their funding costs. So if you know that UOB has historically quite high interest rates for their one account as well as for their fixed deposits. But recently what they've done is they have cut both of these. So a lot of these high cost fixed deposits are starting to mature, and now they're being able to bring their costs down by not offering as high of interest rate for their fixed deposits, and also lowering their one account interest rates. So this is how they are able to grow their net interest income. As for the negative, there's one negative, which is that the operational merger issues in the city Thailand have raised their allowances. So their total allowances grew by 86%, resulting in their credit costs rising 5 basis points year-on-year. But we expect this to normalize in the following 2 quarters, and it should go away, this operational merger issues. So for the outlook, we expect the fourth quarter earnings to grow by 15%, and this will come from more substantial fee and trading income and the loans growth recovery, while the net interest income and net interest margins will remain stable from their lowered funding costs. And they have maintained their FY24 guidance, but they have also provided some FY25 guidance with a very vague higher total income for FY25 from high single-digit loans growth as well as double-digit fee growth. And we continue to expect that the double-digit trading income growth will continue in the fourth quarter, mainly from the higher volatility surrounding the US elections. For the fee, so we do maintain and accumulate, with a higher target price of $37 as we increase the FY24 earnings by 4% from higher fee and trading income estimates, as well as lower OPEX estimates. UOB will be able to maintain their net interest income and net interest margin by continually to cut deposit costs and continuing to increase their loan margins. We expect the fourth quarter earnings to grow by around 15% year-on-year from these reasons. UOB has also mentioned these possible share buybacks, which will further improve their ROE and EPS. But again, no details have been given for the amount or for when it will be in place. So we just have to wait and see for this. I think I'll just answer this briefly, just to wrap up all the banks. There was one question asking which is the preferred bank. We prefer UOB mainly for several reasons, mainly due to the deposit costs, them being able to cut their deposit costs because they have a large amount of deposits that are going to mature and also very high costs. And secondly, they are beginning to focus in the net non-interest income side of their business, while we can see the net interest incomes have sort of been declining slowly. And last but not least, they are also expanding into the ASEAN region as they realize that Singapore has become a bit more saturated. So for these reasons, we prefer UOB. Yep, so that's all I have for the Singapore banks, all 3 of them. I'll now hand it over to Darren for the REITs. Thanks.
Yeah, thanks, Glenn. Yeah, so I'll run through Cromwell REIT's third quarter result or business update. So the title is they secured new refinancing facilities for the refinancing of the November 2025 bond, which expires. Yeah, so let's run through the results, a quick one. So for the gross revenue is up slightly, but the impact was basically because they had a lot of asset divestment. So because of that, it was partially offset by the completion of some of the AEIs. The big one was Nervesa 21, office redevelopment in Milan. So that started contributing this quarter. Yeah, and if you exclude the divestments and redevelopments, the NPI still grew 4.4%. So, like I mentioned, it's due to the completion of Nevesa and some other redevelopments as well. But distributable income is still down because of higher interest costs. Yeah, so the results, these results basically were in line with our expectations. And so for the positives, the portfolio occupancy remains stable. So it improved about 30 basis points quarter on quarter to about 94%. And they still have higher healthy positive rent reversion. So their portfolio currently is still across the board is still under rented by about 7% compared with market rents. So that means that they can ask for higher rents during the renewal cycle. And during this quarter, they had some very high rental reversions like in Milan and Amsterdam, these two strong markets. So Milan had a rental reversion of 30%, while in Amsterdam, because of market growth, we had a high rental reversion of 44.7%. Milan's rental growth was also, or rather rental reversion of 30% was also attributable to AEIs. So it just shows that the AEIs and the asset improvements that they're doing is really benefiting rents. And basically, and for the office portfolio, they signed renewed a lot of leases with no tenant incentive. So that is a huge plus also. And so like I mentioned, the securing of new credit facilities. So they've managed to secure a 340 million euro bridge debt facility. So this facility will be in place until they refinance the loan, the November 2025 loan, or rather November 2025 bond, which currently has a coupon of only 2.125%. So now Cromwell, since they've already this backup bridge facility, their plan is to reissue a new long-term bond to refinance this current bond. So looking at current market, the rate will probably be about 4.5 or towards 5, depending around there. So since they have this bridge facility to backstop that, so now they can properly so-called time the issuance to get the best rate. So now their gearing is at 41%, remains stable. Their policy is to keep net gearing between 35 and 40%. And since the cost of debt is at 3.16 and there's nothing expiring, we expect the cost of debt to remain stable for this year, but next year we expect it to increase to 4% after the refinancing of the loan. And during this quarter, Fitch also, they upgraded the outlook to from a neutral to a positive. So going forward, we think by next year it's highly likely that Cromwell will be able to get a BBB investment grade rating, and that will help to have some savings on the margins of about 20 to 30 basis points. During this quarter, they also had some MPI margin improvement. So improved to 64%. That was mainly because of lower electricity costs, as well as due to the higher occupancy, they managed to pass on more OPEX to tenants. And for the outlook for Cromwell, they are poised to benefit from more ECB rate cuts, and basically they wait for more ECB rate cuts that will help to benefit them when they try to refinance the loan as well, with the new bond, so that they're trying to wait and to time it, like I mentioned. And right now they are focusing on this bond as well as completing another 70 million euros in divestments. So right now this 70 million, it constitutes mostly in the weaker Polish and Finnish office assets. So when they divest this will bring them closer towards their 60% portfolio weightage in light industrial and logistics, and 40% in grade A office. So that is their long-term goal. And so with that, no change to our target price, €1.91. Right now, even though there's some, because of the absence of contribution from the divestments earlier, the absolute DPU is down, but despite that, Cromwell is still paying a forward dividend yield of about 8.7%. So we think that's very attractive. And right now it's still at about 20% discount to NAV. Yeah. So we think that these matrices are attractive. Yeah. Next slide, please. So I'll move on to CLI. So for CLI, the transaction activity is really picking up. So I'll run through the results. So for the revenue is up 1%. But the REIB is down by 2% because that's mainly due to the absence of contributions from India, Australia, and France. So it's partially offset by the strong lodging performance in Japan. So that is from the balance sheet stakes in these lodging assets. And for the FRB, it's up 6%. So there are a lot of movements this quarter. So for the REIT management, there's a 22% decline in event-driven fees. Recurring fees still grew by 1%. But in fourth quarter, we expect this event-driven fees to really pick up because of the acquisition fees that they receive from CICT's acquisition of the ION. Yeah, so event-driven fees will pick up. That's one of the bullet points in my positives as well. And for the PE fund management, the event-driven fees already increased year on year, increased by 8 million. So with more transactions occurring, acquisitions and divestments, these event-driven fees will continue to pick up even for the PE fund management side as well. And on top of that, the recurring fees also grew 6%. So for the commercial management, this 14% growth was driven by new signings from third-party management contracts and as well as better operating performance. The lodging management business, it grew by 1%. It seems a little bit lackluster, but that's because in 2023, they are still receiving some fees from the government's COVID facilities. Yeah, so because of that, 2024, that one-off, so-called one-off, that fees from the COVID facilities, it fell off. So it wasn't extended in 2024. So as a result, it was there was a vacuum there rather from that. And so if you strip that out, the one-offs from the lodging fees, actually lodging management fees, it grew 12% year on year. So that is the recurring portion is stable for lodging management. Yeah, so for the positives for them, they hit their 3 billion divestment target. So right now it's about 4.6 billion divestments. So that is contributed. That's mainly due to the divestment of ION. So ION is already 1.9 billion. So with that, they have retained or converted about 62% of their divestments to funds under management. So that will further increase their FUM to generate more fee-related business. CLI, they still have about 3.5 billion of China assets that they on the balance sheet that they plan to divest. So the timeline for completion is still unclear, but they're trying to do it hopefully within the next 3 years. And another positive is the increased transaction activity that I mentioned. So year-to-date transactions, it rose 90%. So now it's about 2.6 billion. So that is a huge gain from last year. So like CICT and Escort, they contributed a lot of it. And as a result, we think the event-driven fees will definitely pick up in fourth quarter, especially from ION. And another positive is that their growth in private fund space was quite strong, as well as they deployed quite a lot of capital during this quarter. So right as of year to date, they have 1.6 billion raised, and that includes $261 million, or there's a million, 261 million raised from new capital partner, OSK Lines, Mitsui OSK Lines for its Southeast Asia and India funds. And during the quarter, they also managed to deploy more funds as they launched 3 new funds. So these include Australia Credit Program, the China Business Park RMB Fund 3, and the Korea Office Value Added Fund. So these 3 funds were launched this quarter, and it helped to bring the year-to-date deployment year-on-year growth to 43%. So it's year-to-date deployment is 2.14 billion. And for the negatives for CLI, we expect more revaluation losses at year end, but definitely we think that this it won't be as high as last year's 600 million. So due to expanding cap rate still, we think valuation losses will still be in Australia, Europe, USA, and China. But this is partially offset by the strong asset values of Singapore and India. Yeah, so for the outlook, China remains challenging. We see negative reversions across all sectors. Occupancy in office and new economy continued to slip. So now both office and new economy sectors, the occupancy is below 80%. For the outlook, we also expect transaction activity to increase further. So that will further boost the event-driven fees this fourth quarter and next year as well. So like I mentioned, the lodging management, the year-on-year growth seems slow at 1%, but actually if you exclude all the one-offs, it's still 12%, so it's decent. So going forward, lodging management is also expected to improve with more units signed and more units opened. So they opened 7,000 units year to date. So this is more than FY 2023's as well. And for the cost of debt right now, it's at 4.1%. It's still slightly elevated. We think it will improve slightly next year due to some of the interest rate swaps still being at higher rates. Yeah, but you maintain around 4% into next year. So with that, no change to our target price, $3.38. And CLI still pays a 4% dividend yield, which we think is attractive. Yeah, considering it's not really a REIT. Yeah, okay. Next slide, please. I'll move on to talk about Manulife US REIT business update. So we also hosted them for a webinar last week. So Manulife, as you all know, is a US listed, a Singapore listed US office REIT. So the portfolio occupancy continues to be weak at 77%. So it dipped further quarter on quarter. And during the quarter, they also signed rental reversions at negative 7.4%. So they have negative reversions. But they noted that 6 of 9 leases that were signed above market rents. Yeah, and there's a picture of their expiry by NLA at the bottom right. So as you can see here, they have about 9% of their total portfolio that still expires in the fourth quarter, and about 6% the expiry is 31st December 2024. So yeah, if you take a look at that, if they don't manage to refinance or they renew these leases soon, so we expect the occupancy to drop even further by, worst case scenarios by 9%, but yeah, so things are not looking so good for the occupancy wise, but for the capital management wise, the cost of debt still remains about 4.75%. So the fixed rate loans are 59%. So due to the divestment of the capital, they're going to use the proceeds to pay off the debt that is due in 2025. So as a result, they do not have any more debt that is due in 2025, and the next chunk will be in 2026. But right now, their leverage is still way above the MAS leverage limit, so it's in the breach condition still. So it's 54.3%, and the unencumbered gearing ratio is at 58.2%. So for their master restructuring agreement, they need to divest 230 million of assets by December 2024. Otherwise, they'll incur a small fee. So this small fee, the maximum penalty is 2.8%. But because they have already divested capital, which is about half of the December 2024 target, so the small fee will be reduced to about 2.3 million. And the final target for them is to dispose 328 million by June 2025. So if they do not divest any more assets by then, or rather by in 50 days until the year end, you have to pay this 2.3 million penalty. And for the outlook for them, things are still looking challenging for the divestments from the divestment standpoint, as transactions are still muted and there's lack of bank lending. So basically, all transactions are still full equity. If you think about it, how like the asset value is about 100 over million, so there are not a lot of people who have $100 million that can use in cash to acquire as well. So as a result, it's quite challenging to divest these assets. And these assets, as we've seen, are divested at about 30%. Our capital was divested about 30% to discount to valuation. So yeah, it's quite weak still. And at year end, we still expect some portfolio valuation declines, but it's likely not as bad as last year. Yeah, due to interest rates really coming down, things should start U-turning and start looking better soon. Yeah, so that's for Manulife. Next slide, please. I'll now move on to Elite UK REIT. So this is covered by Mara, but she's at the SIA briefing, so I'll help her just talk about it. So for the results, their DPU is up 3.9%. That's mainly due to lower financing costs as well as some tax savings. So their cost of borrowing for this quarter, or rather the results were in line with expectations, and their cost of borrowing for this quarter declined by 20%, 20 basis points to 5%. So we expect that all of cost of borrowing for Elite to remain stable at this 5% in FY 2025. And for them, they also managed to divest Sidlaw House at a price of 41% above its book value. So going forward, they still have some divestments that are in the pipeline. They've received 2 offers for some of their vacant assets. or rather they received offers for 2 other vacant assets, and yeah, it's under negotiation and it's likely that it will be completed in first quarter 2025. And we also think that these divestments are likely to come with some premium to book value as well. Yeah, so for the outlook for Elite, they might increase its payout ratio to above 90% if the year-end valuations remain stable. And the leasing momentum in UK remains not say 100 very strong, but it's been improving. Because we also seen some positive rental reversions for theatre building. So yeah, things are improving in the UK as well. But just to remember that most of the Elite tenants are DWP, so with a long WALE and every 5 years we have a rental escalation. Yeah, so with that, we maintain our buy call on Elite with a slightly higher target price of 34 pence from 32. And Elite is currently trading at an attractive dividend yield of 9.3%. And they've paid off some of their loans so far using some of the divestment proceeds, and they do not have any refinancing risk until 2027. So which is why we are confident that their interest costs remain stable at this level or improve slightly. Yeah, next slide, please. Yeah, I'll move on to Sasseur. So this is also covered by Meow Meow. Yeah, so for Sasseur REIT, their rental income is down. And that's mainly because there's a drop in tenant sales. Yeah, but the results other than that were basically in line with expectations, even though there's a drop. Yeah, so for the positives is that their refinancing is well on track. They plan to refinance this 58 million sponsor loan, and this, when they refinance it, the rate will be at the LPR, so that will result in lower interest costs for them because the LPR now is lower than their current all-in interest cost. And as a result, Sasseur, they project some annual interest savings of about 0.8 million. So the occupancy rate also remains stable. So occupancy of their 4 outlet malls remained quite high, and for the negatives, basically they have some weaker consumption demand, but that's mainly driven by the fact that they had some heat waves in Chongqing as well as some earthquakes in Hefei. So there was some downtime basically for their assets. But the good thing is that Golden Week, they saw sales really reach a record high, 276 million RMB, and that's 28% year-on-year increase, and it's already 55% above pre-COVID levels. So the spending we've noted is that there's some weakness in international luxury goods spending from the Chinese, and the Chinese are moving towards the more value domestic brands. Yeah, so the international brands, the Sasseur, they are trying to ask them to issue more discounts and heavy discounts for the demand to come back. Yep, and for the outlook, the sales for them is supported by the VIP members, so there's a strong growth in their VIP rate. And yeah, like I mentioned, basically Sasseur, they are negotiating more aggressive discounts for the international brands to bring the tenant sales demand back. And with that, we maintain our buy call with a lower target price of 84 cents. So right now, Sasseur is paying a dividend yield of 9.2%, and it's still 20% discount to NAV. Yeah, so that's all for me. I hand over time to Paul. Thanks.
Yeah, thanks, Darren. So I will just discuss about SATS results. Because Meow Meow is in the SIA briefing. I was in the SATS briefing for almost 3 hours as they talk about their capital markets day. But let me just give you the highlights of the results. So the earnings continue to turn around. If you look at the top line, revenue is up 15, and the profit is up from a loss last year. But that 134 million that you see here includes 22 million of FX losses. So actually the earnings is much better than this. So the 2 key trends is I won't run through the details, but the 2 key trends for them is a recovery in volumes. So you can see that the volumes are up almost 11%, and the other thing is also the pricing. So because there was a big repricing in SIA's, the way they contract the prices with SIA, they don't give details on how much of the price increase, but they did get a price increase in SIA, which is their largest customer, and of course the shareholder also. The second thing is because of the jump in revenue, they actually improved their margins, and you can see the number of employees increased, but the revenue rose. Revenue per employee also rose. So there was also operating leverage as the revenue improved. Next slide. The negative is the increase in finance expense. So after acquiring WFS, they've been burdened with debt. But this debt, we think this interest expense that they face right now can be a positive, because as operationally things are improving and the cash flow should improve. So in terms of the outlook, we think second half will still be another strong year, because the pricing, at the very least, the pricing that they got from SIA will only happen in first half of FY25. So second half of 25, you're going to get the pricing advantage too. Volumes are still improving, but we don't expect volume growth. The air cargo that will continue to next year. And the other benefit you get from SATS is that if the operations improve, then the cash flow should improve, and also the interest expense, which is a headwind right now, because as you saw, it went up 11%, should also turn into a tailwind as interest expense decline. Sorry, let me just refresh again, just in case everyone may not understand what SATS does. So SATS, always think of SATS as when a plane, we always use this analogy if you want to understand what SATS does. So whenever a plane flies into Changi or most airports, including the US, or they have in Japan or in Europe, when the plane flies in, they will handle all the food, they will handle all the cargo, handling of cargo, cleaning of aeroplanes. So just think of them think of them as like a service. They service the airlines, providing food, cleaning services, check-in services, baggage handling, cargo handling. So that's basically what they do. Sorry, I should have mentioned this earlier. So in terms of the capital markets, they were giving guidance on their 2029 forecast. So in a nutshell, from FY25 to then, I think we are looking at least minimum is 10%, but we think base case, they think they can grow their earnings about 15% CAGR for the next 4 years, or FY25 to FY21. That's our own estimate, because their net margin guidance that they give was very conservative. But you can just assume SATS is guiding roughly a mid-teens growth at the minimum for them. So actually the guidance was pretty aggressive. So we actually raised our target price because they beat our estimates by, I think, 10 to 15 percentage points. There were some questions why the share price came down. We were also surprised, but we think the one possibility is because the leverage is high. So there's always a worry that they might need to raise equity. I don't know whether they might do a placement or not. I'm not sure, because they never mention anything. But because the gearing is high, there's always this risk, and that could be one of the reasons why the share price was big. But apart from that, the earnings was actually better than expected. And the capital markets, they also give confidence that there's going to be continued growth for SATS. Next slide. Move on to Netlink results, resilient cash flows. Next slide. So Netlink, for those who don't know, is if you have a broadband at your home in Singapore, so they are the monopoly, because they are the only ones who provide the broadband fiber to your homes. Because of that, they are regulated. So all of us pay 1380, used to be 1380, now it's 1350 to your Singtel or M1, and they in turn will pay that 1350 to Netlink. So just in case this is not such an easy company to understand. So the results were within expectations, is always within expectations, because it's very boring, just growing like 1 or 2% per year. The positives is that because right now in Singapore, all the telcos are pushing 1 gig to 10 gig. I think it's mandated actually, but because when you push to higher bandwidth, they will do more co-location. That means the telcos will have to add more equipment, electronics in the Netlink's co-location office. So you can't see it for one particular area, there's probably one huge central office, and then all the equipment for fiber connections there. So they will have to put in more power, and then Netlink will benefit. The other thing is installation, because when we upgrade to 10 gig, they actually have to do some installation work. The negative for us was the operating costs just went up a little bit. We are talking about 1 percentage points, 2 percentage points, because if their revenue is only growing like 1% or less, then any increase. This mainly came from staff costs. In terms of the outlook, the dividends should maintain. They expanded their dividends by 1 percentage points. I think no different for the next few years. Always going to be 1 or 2 percentage growth. But this year there was a bit more pressure on the cash flow because effective April of this year, the connection, like I mentioned, dropped from 1380 to 1350. So the government actually lowered the price. And also they actually had to spend capex for the new central office. So always remember that for a business trust, they call it cash available for distribution. How much they pay for these dividends, it's not like a REIT. For them, they can actually use borrowings, and borrowings is one of the source of funds to pay. So they did tap on borrowings to pay, but mainly because they had to, in the near term, they had to spend extra, I think 70 million 100 million for this new central office in Seletar. So for us, we maintain neutral. Dividend yield is 5.9%, is stable. But of course, the bank's already paying 5%. So I'm not sure what makes the 5.9 attractive. Yeah, but anyway, we have a maintain neutral. And the only thing is that there is a major refinancing that they need to do, because few years ago, they borrowed 500 million at, I think, 1.1% interest. So I think this will have to rise, but I think that is a FY27 issue to worry. Next slide. So for venture, paid to gaze at the horizon, I'll explain why we have this funny title. Okay. So Venture Corp is a contract manufacturer. So the results were below expectations. They were only 68% of our forecast. If you analyze it, should be about 75 onwards. So the earnings was down 4%. Let me just run through line by line. So the positive is cash flows. So this company still has a lot of cash flow. So they pay dividends about 218 million in dividends to pay that 6% yield. But they generate more than that. They generate 400, and they have another 1 billion of net cash. So they can more than raise dividends, and they have enough cash to sustain these dividends. The negative is that the earnings, not so much this quarter, but the earnings since their peak in 2017 when they did ICOS, heated cigarette, the earnings has just come down. So they are like the past 7 years, even though when you had COVID, all the electronic companies recorded record earnings, record revenue, this company continues to decline in revenue and earnings. So from the peak to now, it's down almost 30%. So the biggest thing, I think why the market sold down on these shares is the guidance. So they actually lowered their guidance. So in the 3 months ago, the guidance was second half will be stronger than first half. Right now, they changed it to stronger to relatively stable. So we had to bring down our numbers by 6%. So their outlook statement is, they say that there's good opportunities. I'm just going to read it out because since they like to use, they always say to emphasize on their outlook statement. So the growth opportunities from life science and AI data center are on the horizon. Of course, don't ask me how far this horizon is, but there is a horizon. So that's why we said they're getting paid. So you're paid 6% yield, which is a very attractive yield. And as we look out in the horizon, I know when the thing will return, but which I have no idea when the horizon will come. But so that's why. But this is definitely a value stock. And one thing good to note is, despite all the sarcasm, is that their profit is actually stabilizing. Although it's declining, but there is a level of stability coming in. So this is really a value play on contract manufacturing. So you're getting 6% yield, just that you're not clear when the recovery will happen. Next slide. So I'll move on to our usual weekly update. So for Singapore, we had some data points. So we had visitor arrivals into Singapore. It continues to be strong. It picked up from 12%, so 17%, still very strong. A lot of it came from China arrivals, because of the Golden Week. So China arrivals actually doubled year on year. But listening into Paragon results and looking at Genting results, I think although tourist arrivals have been strong, a lot of the tourists are not spending on discretionary items, especially luxury items, and at least for Genting's point of view, the VIP gaming. So luxury has been hit. I think Paragon also mentioned that luxury spending has been exceptionally big. I mean, this is just some observations. Retail sales in Singapore continues to be sluggish. I think, like you say, the watches is down, apparel and all that. And I also, my guess is that everyone's burdened by the car sales. I think car sales is up almost 30% year on year. Construction industry is still doing well. So you can see that construction award, although it's down 7%, but month-on-month numbers are very volatile because of the lumpiness of construction contracts awarded. But year to date, you can see that it's still 34% amount of contracts awarded. And if you analyze it, that means you take the last 12 months, contracts awarded in construction is 42 billion. So this is the record high. This one nothing much. There wasn't much data points, but you can see that even though all these trade tariffs on the US, US still has like a 31 billion per month trade deficit with China. So this will, I mean, without stating the obvious, this will only give Trump, I guess, more ample reason why he will impose that 60% tariffs, because the deficit is still huge between US and China. So if you take 30, you times 12, you're talking about 350, 360 billion kind of deficit, trade deficit that US has with China. Next slide. I'll move on to our tactical views. It's only been 5 days since he's been elected, so there isn't really much details of what he's going to do, but we'll show some charts later. But I mean, but just on the asset allocation, as much as we can do, from a very top-down macro view or macro lens, we are looking at long US equities, because under Trump, he's probably going to cut corporate taxes and also going to increase the fiscal deficit. So it's going to be, I guess, a party time for US domestic equities. But the one that could hit the most is China, short China and Europe, because of the potential threat of a trade war with the US. So you can imagine if there's a 60% import tariffs imposed on China, you can see the hit on the export sector, the hit on jobs in China and so forth, because exports were supposed their main source of growth in China. In terms of bonds, I think it will be the opposite. It will be like favorable on European bonds and negative on US bonds, because in Europe, you want to join the EU, you have a maximum 3% fiscal deficit to GDP. Unlike in the US now, it's hitting 6-7%, and under Trump, the trend line is probably 8% fiscal deficit to GDP. So European and also with the slower growth, it's more likely that the ECB will cut rates more than the Federal Reserve. Commodities will be long gold. I mean, it's just a hedge against the ample supply of money. Probably the sell. So if the bond markets get sold down, then I think investors might actually swing to gold to avoid the sell down in bonds. So that's one thing. And of course, the geopolitical hedge. And their short will be, if Trump will reverse some of these renewable policies, all these green industrials, you're talking about lithium, you're talking about nickel, all this could get hit. Essentially, there'll be less EVs. So the other piece of news that came out last week was the Fed cutting rates by 25 basis points. The other thing to note was they said that the elections has no impact. So the worry as the bond yields have started to rise is because if the Fed might want to preempt and not cut rates because he thinks that there will be a wide deficit. So basically, he's just saying he's not going to do that. So what it means that right now the market is pricing a 75 probability of a rate cut in December. Our base case is also 25, but we just not much of a conviction because we worry inflation will still remain stubborn. And the upcoming jobs data could be very strong because of, the previous week, the jobs data was hit by the hurricanes and also hit by the strike in Boeing. So in terms of a tactical view, we just think that those REITs in Singapore, with 5%, 4+% yield will be challenged. It will be challenged because if you look at the banks now, so banks are paying 5% yield. And in the fourth quarter, like what Glenn mentioned, the earnings is going to be strong. So I think he's looking at almost mid-teens to almost as high as 20% earnings growth in the fourth quarter. So, and also as next year's results come out, there's probably going to be upside in bank dividends. So we just think that all these REITs, Singapore REITs that have like 4% yield and 5% and below yield is going to be challenged. Because even if they make acquisitions, how much can they grow their yields compared to the banks where the fourth quarter results is going to be strong? So, but we do see value. The value that we see again, this is just my own view. Separate from Darren. So, we see value in overseas REITs like Cromwell, Elite, and First REIT, which he has a buy on most of them too. So the last one is China. So there was a lot of expectation in the National People's Congress that China will announce something. So there was no bazooka because market was expecting maybe a 2 trillion fiscal stimulus. That means they're going to central government going to spend extra 2 trillion in spending, but it didn't happen. Instead of bazooka, we have a fire hose. So they announced a 1.4 trillion debt swap for 4 years. So what this means is that all the local governments, they will give whatever 1.4 trillion of their debts, they will give it to the central government, and the central government will just absorb their debts. So this is structurally positive, but it's just another liquidity measure because right now local governments, the provincial governments have problem paying their staff, have problem paying suppliers. I mean, it's a well-known thing in China. So this will, without the debt, now they got more liquidity to pay this off. But the problem is that it's just another liquidity measure. It's just to ease liquidity. It doesn't boost demand, aggregate demand. So investors will look hoping that because if the private sector are not spending and cautious, then they were hoping the government will be the one spending to boost the whole demand in China. So that's not happening. So we might see it, but so instead of a bazooka stimulus, they're going to face a bazooka tariff by Donald Trump. So hopefully by then, that's when the central government will need to do some extra spending. So right now we need to see liquidity measures and things to boost the stock market, but again, nothing to push the demand in China directly. For the events, we have a few results. We have Singtel, Electronics, AM, Comfort Delgro. This is just for your reference, and we have a few corporate insights as we end the year by middle of December, where our last webinar will be on the 16th. Next slide. So this is just some illustration. I won't go through too much, but this is just to show that the blue line here, that arrivals continue to rise, and you should expect arrivals in Singapore to grow, and it will be a growth driver for Singapore GDP tourism, because we haven't even hit the pre-pandemic levels yet. Construction, you notice, is still very strong. The blue line is the awards. So this is the last 12 months. You can see this big surge, the blue line starting to surge. The red line will happen later on because these are awards. Then payments means the actual the actual work done. So this one will come in later. Next slide. So this is just an expectation. So September actually should be October or September, November actually. Yeah. So right now we are looking at 4.6. Right now the expected cuts. So this is just the trend line. I'll put some dates next time, but the data here shows that the market is still expecting one more rate cut by December, about 19 basis points. Then first quarter, possibly one more cut. So in general, we're still looking at 4 more rate cuts. The market expecting from here to end of the year. Next slide. End of next year, sorry. Yeah. So again, because of the what are the things that Trump is going to do? I'll just quickly flash this because in view of time. So one of the things he's going to do is mass deportation. So in the US, you got a few types of migration. You got the green card, then you got those foreign, some students working, and but this one is so-called illegal immigrants. So the estimate here by the BOE is probably around 2 million. So what might happen is that if Trump comes in, he might immediately try to take out at least 1 million of these immigrants. So this will cause inflation pressure. I won't run through all this, but just for your understanding, what are the things that people are looking at? Next slide. So the next thing that he's looking at is, of course, a 60% tariff. If you look at this chart, when Trump was president and he announced his tariffs, you will notice that the imports from China really collapsed. So if he announced 60%, you can expect this rate line to, I don't know, even go below Southeast Asia. So this is the opportunity, as the title suggests, this is the opportunity for Southeast Asia. So it could be like China +1 to maybe minus China, then go plus Southeast Asia. I mean, this is a joke, but this is a big opportunity for all the Southeast Asian manufacturers to replace China. Next slide. So this is my second last slide. So this is just to show the deficit. So if Trump comes in, then the worry is that he's going to spend more. So the deficit, the red line here, deficit to GDP will be hit almost 8% from the current 6-7%. I won't run through all this, but just to give you a flavor, what are the things people are expecting. Next slide. So I'll just move on to the last one. I attended the Singpost analyst briefing. So for those who are not sure, so Singpost is not just, of course, postal service. They also have in Australia, they have 4PL and 3PL logistics. So 3PL basically means, your trucks, your warehouse. 4PL basically means I not only do I own all these assets, I just manage other people's assets. That means I'm like a arranger. I don't use my warehouse, but I can use other people's warehouse. But in Australia, Singapore, Singpost has both, and they have international parcels. And I forgot to put, so they actually own Singpost Center, where you notice on the left here, which gives them almost half of their earnings actually come from Singpost Center. So the earnings was strong. The core net profit was 87%. Sorry, I missed the percentage here. Almost double to 25%, 25 million. On an annualized basis, this means that 22 times PE. I won't run through every single thing, but just to my last comment is that I still think that the share price drivers for Singpost are intact. They mentioned if they were to sell the Singpost Center, which is worth 1.1 billion, I think they did mention that. So you can notice, of course, their market cap is 1.1 billion. They could. So the worry is that if they sell this, then what happens to earnings? So they actually have right now the finance expense for them, I'm not sure I put it here. Okay, the finance expense for them is about 24 million. So assuming they do de-gear, they sell off Singpost, I mean, just a scenario, they could actually bring down the debt to zero, I mean, if they want to, because the debt is 800 million. So what this means is that even though they might lose the property earnings you see from here, they could actually replace it by zero interest expense. I'm just talking on paper. So it doesn't mean that they sell Singpost, the earnings will just collapse. It also means that their interest expense can disappear. So that's one positive. The second thing is, I think there is room for them to dispose part of the Australia stake for valuations of 1 billion. So if you take 6 to 7 times EV/EBITDA, you could hit those kind of numbers. So the third share price trigger is that they could actually, they are still talking to the authorities to restructure postal, and the postal is they are losing the losses here. If you look at the fifth bullet point, actually the postal network part, that means running all these post office, actually makes them lose almost 8 million every 6 months, or maybe 15-16 million per year. And running a postal office, there's a bit of a community service in there. I think sometimes we go there to buy stamps, and I mean, to lose 16 million for people to buy stamps, to do some registered mail. So there is room for them to shrink the postal network. So if the authorities allow them, they could shrink it and they could narrow the loss. So this could be one of the things that could restructure. So in conclusion, there is a few share price drivers for them, which is, I think, still intact. I think the share price, there's also another question why the share price dropped. Maybe investors were thinking, because of all the Bloomberg speculation, that at the results briefing, they might actually announce something in Australia. One scenario is that maybe they sell 20% of their Australian business at, I don't know, at a 1 billion or 1 billion plus kind of valuation, and maybe can par down that and kind of crystallize some value. But I think maybe the investors were just disappointed that that didn't happen. But in my own view, is the share price drivers are still there. Okay, thanks everyone. Sorry, this is a bit long for my side here. Yeah, I think we can move.
Yeah, thanks, Paul. We let Paul take a break first while we answer some questions. Yeah, quite a few bank questions. Let me jump to this first one. Okay, so it's asking about the outlook for Singapore and US banks going into the fourth quarter as well as 2025, mainly on the back of the Trump trade going forward and the Trump win. So this is asking what is the expected trade-off with reduction in corporate taxes and versus the higher tariffs keeping inflation up, resulting in slow or no rate cuts. I would think the second point where you said the higher tariffs and keeping inflation up, resulting in slow or no rate cuts, is beneficial for the banks. right? So both, reduction in corporate taxes. I think this is more for the US banks. Yeah, and the higher for longer interest rates are actually beneficial for the banks, where they're able to see, their NIM and their net interest income grow. But of course, you on the flip side, you will see that those banks that are more heavily dependent, maybe on the fee income or wealth management income, banks like Bank of America, they might feel they might not grow as fast because, if the higher for longer rates are in, then deposits may be more attractive to their customers rather than, going into fee income. So that could be one of the negatives, right, for the banks going forward. But I think all in, if you look at the banks, how they're going to do in the fourth quarter, they're going to do well. I have mentioned it earlier, both the US and the Singapore banks. Now, even more so with the Trump wins, you can see that all the banks have actually shot up. Their share prices have surged, right, due to this expectation for higher for longer interest rates, which are beneficial to the bank's net interest income and net interest margins. But I know we could see loans growth slow down. We may not see this recovery in loans growth, and also fee income growth could sort of damper off as we go into next year. I think this year is still quite strong for the fourth quarter, but next year you have to see that the growth we usually measure is year on year, right? This year is quite a good year for the banks for FY24. But FY25, can they repeat the same performance, and get double-digit growth? It will be it's a tough task to do for them because they are coming off now a high base. Instead of, if we compare to FY23 when the base was so low, that's why we see this double-digit increment, every quarter, since the start of the year, right? So that's one of the reasons why we may not see this very, very large growth, but I think it'll still be coming in at around high single digit for fee income. Okay, moving on to the next one. For DBS, did their loans growth contribute to the overall net interest income? Yeah, I think their loans growth did contribute a bit, but I think the most prominent contributor and the biggest contributor to their net interest income wasn't loans growth, right? Loans growth is minimal. I think it's them being able to move they have a lot of excess deposits, and them being able to reprice these excess deposits, right, into higher yielding interest earning assets, which is how they are able to benefit their net interest income. So DBS, I think there's another question, is a follow-up. How much can this benefit them, right? Because they have 55 billion of fixed assets. They don't say what they were priced in at, right, before. So they don't release the information. But if you assume, let's say a 1%, right? 1% of 55, if that they were earning 3% and now they're earning 4%, you can assume it's a couple of, I think it's a couple of 100 million that can benefit their net interest income. If we just do a very back of the envelope kind of calculations. But of course, they're also very dependent on when they reprice it, at what point are they repricing it, and if the longer tenure rates are actually beneficial. Yeah, someone asked about the target price. Yeah, they are. Yeah, that's why we have a new. Sorry, where did that question jump to? That's why we have a neutral on DBS, because our target price. So we do target price plus the dividends to get the returns. Okay, answered this one about the fixed asset repricing. UOB is already regularly buying back shares. What is the difference in the share buybacks that you mentioned, please? Yeah, good question. So UOB is buying back shares, but the quantum is so small, right? They have so far, I think, bought back like maybe 14 to 20 million, depending on when they bought it back, right? But average, I think, is less than 20 million Sing dollars worth of shares. You look at what DBS has said and mentioned, there's a good marker to look at, right? They said 3 billion of share buybacks. Right, if UOB, their current share buyback program is very small, it's really minimal. It doesn't even move if you look at the number of shares that they have, right, it doesn't even move the last digit much, right? Maybe it moves 1 or 0 kind of thing, right? It doesn't move it much. So you're talking about millions of shares, right? They buy back very, very small. So if they were to go on a share buyback program, right, we would be expecting it to be much larger, and there will be some meaningful impact to firstly the number of shares, right? So this will lower the number of shares, and then this could better benefit their EPS as well as their earnings per share and their ROE as well. Yeah, so that is what a lot of the investors and analysts are quite excited to see what is the quantum that they're going to have this share buyback program. For them to even announce it, I think it will be a meaningful amount and not the previous ones which they have been doing on a yearly basis, where it's just a couple of 100,000 kind of shares. Yeah, that's really quite a small amount. So I think that's the main difference, is the amount. Okay, another good question here. Let me answer this one first about the banks. Why did Singapore banks rally last week? Flight to safety due to the US and global political ramifications, or sustained fundamental growth in the local banks? I think it's all of these. It's not an either or question. It's not a chicken egg. I guess it's all these factors that come in at the right time, which is why the banks are able to benefit, and the bank's share price have all spiked up. Firstly, I mentioned earlier, higher for longer interest rates will benefit the banks, because the net interest margins and net interest income will benefit. Secondly, like what you said, their fundamental growth is strong. They are all performing well. They all have expanded, right? They have done acquisitions into the regions, not just focusing in Singapore, because Singapore, sadly, is quite hard to grow the loans, and it's so saturated. So they are going outside of Singapore into ASEAN. And thirdly, like you have also mentioned, is the flight to safety, where banks are seen more stable, and like Paul has said also, the dividend yield is very healthy, and they are all committing to some sort of increased DPS, right? Whether it is 50% dividend payout ratio, where they are they see earnings rise, dividends rise as well, or like DBS, they are giving this 24 cents per annum increase, and they are committing to that amount. So I think that's all these factors come together, and you'll see that the banks have performed well. Oh, sorry, I lost that question. Where did it go? Yeah, so I hope that answers for that part. Another one. Yeah, so someone said good call on UOB, stock did really well. Yeah, thanks. Yeah, I think if you look at all three banks, UOB was the one that performed the best if you look at the past few days, yeah, because mainly from that share buyback program which they did, which is a bit of a differentiator compared to the other two who didn't really announce anything on what they're going to do with the excess capital. Another one. Regarding the OCBC's trading income, we're saying that where does this trading income come from, and it's transaction fees. Yeah, so it is transaction fees, not so much the trading gain, and it's mainly from this volatility. Like if you see in the August, right, where the yen carry trade, so the volatility spiked up, which is why you see the trading income spike up. And going forward, right, into the fourth quarter, we will expect it to have a similar performance, but maybe not as strong as the third quarter. But this is due to the volatility surrounding the US election. So before the US election, before the Trump was announced, right, as the winner, right? So before that, there was a lot of volatility as well. So we will probably see trading income perform well in the fourth quarter of the year, and that's the main reason. I think I have one or two more. Let me see. Between US and SG banks, which are likely to benefit and have a higher share price increase effect? I think if you look at this, it's really hard, right? Because Singapore banks, I really can't say which will be better. I think both will benefit a lot, right? And they have benefited. You have seen the share price increase quite a lot, right? It's really whether or not you want the dividend. So the main differentiator, right, between the US banks and the Singapore banks, I think it's firstly the size, of course, and the markets. But I think the other one, as an investor and a shareholder, you'll be looking at the dividends. US banks don't really give very good dividends, right? It's around 2%, whereas Singapore banks is 5%, right? So, but then again, on the flip side, DBS, Singapore banks, their share price doesn't fluctuate as much, right? So you're not really to see as much gains, right, as compared to the US bank. So there's a bit of a trade-off here and there, right? Which you prefer? You want to have a stable, every half yearly or quarterly dividend and a healthy one at around 5%, or you want to see some capital gains with the US banks where the share prices can really spike up a lot higher, but then again, it can also decline quite a bit. Yeah. So I think if you want to see which has a higher share price increase effect, I think that's the US banks. Singapore banks are generally more stable in that sense. But if you want dividends, then of course Singapore banks, that is the other side of the coin. Okay, what is the outlook for SGX after recent price surge? Do you think any further upsides going in 2025? Yeah, I think for SGX, the volatility wise will definitely benefit, right? Their equities markets line, and we could see earnings actually go up. But what will be the negative will be the treasury income. But then again, with now the higher for longer interest rates, I think treasury income will start the downside, the decline will start to stabilize for SGX. But I think the main question a lot of the shareholders are asking why the share price doesn't really move is because they have kept themselves in terms of the dividend policy. While their earnings have been increasing quite well, they don't really give it back, right? The dividend yield is quite low. Their dividend payout ratio is also very low as compared to the bank, right? Where they are giving back a portion of their earnings, while SGX is not really giving back that portion. So maybe until we see a change in their dividend policy where they are giving back more of their earnings to the shareholders, we could probably see some more upside to SGX. But definitely, if you talk about earnings and bottom line, it will improve going into 2025 due to the volatility, the increased heightened volatility we are seeing. No news on dividends from UOB and OCBC. Yeah, no news. Sadly, they did not give any indication of where dividend is going to go. They just hinted and mentioned that there will be some return. They want to return capital to shareholders. I think the main outlier is OCBC because they are at least UOB they mentioned share buybacks. OCBC did not mention anything. They just very vague. Right, and they have the highest CET1 ratio. As I mentioned earlier, 160 basis points or $4 billion worth of their CET1 that they have to return. So are they going to do any acquisitions? They never say anything. Are they going to give share buybacks or special dividends or higher dividends or even give over their 50% dividend payout ratio? Also no news. Analysts like us, like me, have tried to ask, but no, they are refusing to answer and remain very silent on that. So hopefully fourth quarter we'll see something from OCBC especially. Why is someone asked also, sorry, previously about another question on iFast, right? Why is it so volatile and why is iFast falling? I think iFast, I think because there are a lot of people are sort of taking their bit of their profit from iFast, and also they are still loss making in terms of their bank, right? And the Hong Kong e-pension portion the revenue has been already priced in, right? So what is their growth driver now, which they're banking very much on the UK global bank, but it is still in a loss-making stage. They're still trying to grow. So it's if you look at that, a lot of people will say comparing them to a local bank and say that what if I want to buy this loss-making bank, why don't I just buy a local bank that is profit-making, right? So that could be the why is it falling and why is it so volatile, because people are comparing them to a local bank, which is why they're not, maybe their share price isn't performing as well. Yeah, I think this will take some time for them to show how their global bank is growing and how will it benefit their overall wealth management platform. Okay, I think that's it for me. Yeah, I think I've answered all the bank questions. I'll hand it back to the rest of my colleagues. Yeah, thanks.
Yeah, thanks, Glenn. So I'll just take a few questions. What's your TP for NVIDIA? Our TP is 155. Right now, I think price is about 140-ish. Yeah, 147. So fairly close. Another question here on what is Meta's net margin. So net margin for the third quarter is about almost 39%. What we're modeling for this full year is about 37-ish percent, which is quite a significant step up from last year. Yeah. But yeah, I mean, almost 40% net margin is pretty good. There's another question here. Will Tesla TP be raised after Trump win? Any changes fundamentally? So actually, no real changes fundamentally. If anything, it might even be more detrimental if there's more trade tensions with China. And if anything, actually, Trump has always been very pro-oil, pro traditional energy versus new energy. So might not be as good for EVs or clean energy, but tough to tell. Yeah, I mean the stock price is up quite significantly over the last few days, but fundamentally, no real changes actually. Well, at least in the near term, none that we can really think of. There's still quite, in terms of the core EV business, there's still quite a lot of headwinds right now. Here's a last question for me here. What's your view on competition on AMD versus NVIDIA? What is the market share? So, sorry, I lost the question. Yeah. How far is AMD behind? So actually right now there's really no competition. I think if you just look at numbers alone, AMD is roughly 5 to 10% market share, NVIDIA is the rest. And that's just from a number standpoint. How far is AMD behind in terms of product itself? It's typically about one iteration behind. So for example, their new 325X will be same as the H200. And they're launching at the same time as Blackwell. So typically, because NVIDIA essentially has an annual cadence of new product launches, it's tough for AMD to actually catch up unless there's some significant leap in technology that they're able to harness, that they can jump on in between product iterations, but otherwise it'd be quite difficult. Yeah, so AMD is actually, if anything, the gaps it widening even more, because when you look at just how fast supply is ramping for NVIDIA, they're ramping about 3 to 4 billion a quarter, whereas AMD is like maybe 500-600 billion. Oh, sorry, 500-600 million. So for every quarter that basically keeps carrying on, NVIDIA just keeps gaining more market share on NVIDIA keeps gaining market share on AMD. From a numbers perspective. Yeah. Okay, I think that's all for me. I'll hand it back to the rest of my colleagues. Thank you.
Okay. I guess I'll take over some Apple questions. I have an impression that Apple services growth has slowed down. Is that a concern? Yes, it has slowed down a little bit compared to the last 2 quarter growth, which is around 14%. So this quarter it was around 12 to 13%, which is why some analysts think of it as a disappointment. But I say it's still pretty healthy growth. As I mentioned before, most of their earnings are actually recurring, and their install base is constantly increasing. So it's almost certain that their services revenue will grow. And we think with the rollout of iOS 18 and Apple Intelligence, there will be more space for growth, because the product upgrade cycle will definitely impact the install space. So that a return is going to increase services revenue. Another question is, why are analysts overly obsessed by iPhone sales numbers when the other businesses are doing well? Well, because iPhone itself accounts for almost 50% of Apple's entire revenue. To take the previous quarter, for example, iPad and services both have very, very strong growth, but just because iPhone was flat, so the overall revenue growth was like very low digit. And if you were to say other businesses are doing well, I guess the only one that's doing consistently well would be services. We think Apple growth compared to other Magnificent Seven companies is considered pretty flat and minimal. So the only killer weapon they have in the short run would be the Apple Intelligence, which essentially could be revolutionary to the mobile industry. And that is going to affect iPhone sales as well. So at the end of the day, it always boils down to iPhone sales number. So I hope that answers your question. And I thought there was another question with regard to Amazon's CapEx. Sorry, hold on a bit. Oh yeah, Amazon has a higher CapEx to continue. Where would the CapEx be directed to, and what is the estimated value? So they have estimated FY24 CapEx spending of $75 billion. So up to now, the third quarter, they've already used up 50 billion. So that means they're going to use the remaining $25 billion in the last quarter. And they've also forecasted FY25 CapEx will be even higher than this number, but they didn't say specifically how much. They have mentioned that majority of the capex will be diverted to AWS, but they will also spend some in enhancing the retail segment, particularly upgrading the fulfillment and transportation network. So they have mentioned that they want to improve their same-day deliveries facilities. So yeah, these are the areas that they're going to divert the capex to. I guess that's pretty much for me. I'll pass my time to the rest of my colleagues.
Yep. I'll answer some questions. The downward trend for S REITs, what's your recommended picks? Yeah, with Paul on that we like more those that are so-called value with higher dividend yield, like those overseas assets. Like Cromwell, First REIT, and Elite. But I'll add one more. CapitaLand has got also that is one of our top recommended picks. That's mainly because they have a very geographically diversified portfolio. So any weakness in any geography can offset each other with the strength in another geography. Like for instance, if you think Singapore, the outlook for REPA might not be as strong as before, and we forecast a single-digit growth in REPA. But this can be further boosted by the Japanese very strong REPA growth. So Class is also a CapitaLand name, and it's also paying a dividend yield of 7%. So we think that's attractive, and they've a lot of inorganic growth opportunities, which we think can further boost their income. So there are some of the, and I mean the inorganic growth opportunities as AEIs and such, they've already proven their track record. So we think that is attractive. Yeah, so the answers that will REITs go on another downtrend in the next 4 years due to Trump? So this one is similar to the another question where it is asking, is the outlook of Singapore REITs with Trump, will REITs be collateral damage, especially if overall interest rates stay up to curb inflation due to across the board import tariffs? Yeah, so of course it's really hard to say what the Fed will do, like whether they will increase or hold the interest rates high. But from my perspective is that the interest rates have been high for so like a year plus, at least 5 to 5.25 range. So above 5% Fed funds rate range. So I think the share prices have already reacted to that and already corrected quite significantly. So going forward, even if the rates hold stable, I mean that's the worst case scenario. The rates hold stable at this rate. I think a lot of the impact has already been factored in over the past couple of years. So I don't think the share prices will continue, will crash in that situation. Yeah, so I mean that's just my view. So worst case scenario, if rates stay high, I think it's already so-called priced into the share price due to the fact that the past few years the share price is really quite weak. So any rate cuts will definitely still benefit REITs. That's like higher DPU, absolute number of DPU going forward. So yeah, so that's just my take. But yeah, definitely the share prices, it'll be hard for a rebound if the interest rates remain high. Yeah, what's the outlook for Class and CapitaLand? Yeah, so for Class, I talked about it a little bit. Yeah, so inorganic growth will be from RevPAR growth and stable income sources. And any inorganic growth will be from their continued portfolio reconstitution efforts where they've proven that they've managed to divest some assets at good premium to book value and sell assets at a low exit cap rate also. And my outlook for CapitaLand, so CapitaLand, basically they have still some potential for positive rental reversals because their leases or the current rents are still below market. So but the macro for office is that even though there's some new supply coming into the market, we still see rents holding up. But I think next year we'll start to see rents coming down. I mean, that's just my personal view. But for most of the REITs, a lot of their current rents are still way below the 11.95 grade A average. So as a result, like Apple REIT, they can still see some positive reversions in Singapore. your REITs target prices are based on what assumptions on forward US Treasury rate? Yeah, so that's a good question. So actually, most of the REITs that we cover, we have not really adjusted our risk-free rate yet. So once we adjust our risk-free rate downwards, the share prices are slightly likely to be increased again. So yeah, we've not really adjusted our assumption on the forward risk-free rate yet. Yeah. So for Singapore, we've used a target rate of about 3%. Yeah, US definitely is higher. Like US, we're using 5%. What's your take on FCT now that Trump has won? FCT, we still think rental reversions are still intact because even though tenant sales are slowing, there's still some demand there, and we also see some retailers from overseas coming into FCT, at the like Causeway Point, for instance, like Malaysia retailers coming to Singapore. So all this has some uh like like overseas retailers, basically there's more demand, and the outlook for retail sales, the tenants are still willing to pay more because occupancy cost is still about 16%. So that's below pre-COVID levels of about 17 to 18. So there is still some room for rental growth for them as well. So that's also why we see rental reversion still keep increasing, even though the tenant sales growth has really kind of normalized around 20% above pre-COVID levels. Yeah, so yeah, we have a cumulative call on FCT. Any idea how much fee CLI will receive on the ION deal? Oh, I've not calculated that. Let me could you email me if you could drop your email, I'll reply and I do the calculations. Could you please share with us your outlook on impact over the next 1-2 years? Yeah, so for Mapletree Peninsula Trust, their portfolio in Singapore is very resilient, like which contributes about 50% of the MPI, like VivoCity, MBC, and other properties that they have. So we've seen some very good positive rental reversions for those. Like the Mapletree, the MBC they had some 2% rental reversions, while VivoCity, like retail, we've seen very strong rental reversions, 17%. But the weakness in the Mapletree Pan Asia is their overseas assets. So that includes the Festival Walk and the China and Japanese properties. For Japan, is very weak this quarter. Like we've seen the Makuhari region, or rather the sub-market in Shiba. There's some tenant that already vacated, like Seiko that vacated, and Fujitsu also indicated that they are going to not renew their lease. So there's some weakness there. So for impact, half of the portfolio I would say is strong, like Singapore, but the other half is still weak, and the other half of the portfolio, like Festival Walk, China and Japan and Korea as well, all have negative rental reversions. Yeah, so we think that will likely remain. Yeah, that's our view. What's the outlook for Suntec REIT? Any share price have been tracking despite good tourist arrival? Yeah, so for Suntec REIT is covered by Meow Meow, but just my take is that rental reversions for Singapore still likely to maintain strong. Like office outlook, maybe we're thinking about single digit rental reversions because the leases are still, like I mentioned, it's under rented. Like the current rents are below the average market passing rent. And for retail, Suntec retail is strong at 20%. But for Suntec, their overseas assets continue to be a drag. Like the Australia assets are weak. Like with very high vacancies. Their UK assets also weak. So overall, we still have an accumulate call on Suntec with a target price of $1.23. Yeah, and the good tourist arrivals is basically the fact that even with the strong tourist arrivals, we see them, a lot of them spending less and not on those luxury products. So the spending from them is really much lesser than pre-COVID. So there is a drag there. Cromwell Elite First REIT, are they value traps even though they have high yields? I don't think so, because first of all, their share price has already fallen quite a lot, and we've seen Cromwell actually the top performer in the third quarter. They've grown the share price by like 20%. I don't think it's value trap because their portfolio is also relatively stable in value. Yeah, so I don't think that is a value trap for these three. Yeah, let me just see if any now hand over. Yeah. Oh, what is class? There's no ticker code for class. Yeah, class is CapitaLand Investment Trust. Yeah, I think I'll hand over time to my colleagues. Yeah, due to shortage of time also. Yeah, thanks.
Yeah, thanks, Darren. Let me just answer as much as I can. Why SATS down despite good results? I think that we mentioned this totally speculation. Perhaps there's some worries of capital raising exercise to de-gear. Hi, Paul. Can you invite Grand Venture for webinar? They have good fundamentals and yet share price is languishing. Need more exposure. Yeah, we will send them invite. I think thanks to everyone. We actually do send. I mean, like there were requests for Grand Banks, Balsted. We do try and catch up with them. So that's why we got Centurion, we got Penn United due to everyone's request. So we will take note. Most probably all this will be done next year because it's really year end. If you do one in December, nobody will attend anyway. So we will definitely go and send them an email and ask if they want to do it. But thanks for the suggestion. What's your take on Seatrium's latest update? So for Seatrium, my own so they didn't give much financials. There's no revenue, no nothing. The only number that you can hang on to is the order book. So the order book last quarter was 26, this quarter was 24 billion plus. So it's down about 1.7 billion. If you use that as revenue, the second half versus second half of last year. So second half last year, their revenue was about 4.3 billion. So this half, if you based on the order book, you probably could see a flat revenue. My own guess, this totally guess, because of the decline in order books. I don't think there'll be anything. I hope I don't. My own view is I don't think there'll be anything interesting for rest of this the next 1.5 months or 2 months for the rest of the year. The most interesting comment they had in the briefing was in 2025. They said Petrobras is looking at three more rigs. For us, we know there's confirmed one more. So if you recall, Seatrium had this huge order book from Petrobras. I think it's 11 billion from the P84. Then they had the FPSO, then the P85 FPSO. So it's all over the news that the P86 is being tendered now, and probably the award will be in next year. So I think like 99% chance it's going to be them because they like to do a series. So if you do a series of this P series, you can get like cheaper price because it's the same. So they did mention there's possibly 3 more FPSOs. So I think any story will be most likely next year rather than this year because it's really year end, and I don't think Brazil going to work in Christmas time. So basically, I don't think there's going to be any contract awards in December. I mean, that's my own guess. Any view on UMS? Yeah, I just we'll do a film on the ground next Monday, but they just had their call. So the earnings was down about 30%. Again, fourth quarter, I don't think there's going to be anything happening. So the 2 main issues for UMS is their existing customer, which we believe is applied, is the orders isn't strong, so it's probably going to be flat. And in next year, there could be a bit more growth. Then the new customer, which we suspect is LAM, that can give growth. It's probably maybe 10 million now, and then maybe next year could actually jump maybe to 50 million. So again, this is just estimates. So the main growth you have to look at is the new customer, but they are facing a bit of execution challenges because it's a new plant, so their workers can't hit they don't have enough enough employees, and also the ability to hit the quality targets is still a challenge because it's all new, because it's a totally new plant, so that takes time. But I think for them also going to be a 2025 story, so I don't expect any momentum for the next 3 months. For them, because the fourth quarter I don't think will be strong anyway. Why Singpost down despite good results? So Singpost, I'm a bit surprised too. We think the share price catalysts are still intact, which is all this restructuring. The only negative, as I mentioned, is for Singpost is that they did say many times that the Australia business is slowing down. You don't see it in the business, in the operation. So they just say that the consumer spending in Australia is trending down quite sharply. So I think the macro environment in Australia is pretty slow. Likewise, they said in Singapore too, the e-commerce. So that's the only challenge I think for the share price is the operationally. You see Australia earnings did very well was because of the acquisition they did of Border Express. So that is the one negative. Sorry, I didn't highlight earlier for Singpost. What's your Olam? What's your view on Olam's sale of OA? Can it fetch? How much can it fetch per share? What is the value? So that the sale of OA is almost the whole market cap of Olam. If you do the back envelope, I'm not sure how much debt is tied to that valuations, but it's almost you get one after they sell OA, you get the whole OFI for free. Which the earnings for OFI is probably like 10%, 15% lower than OA. So yeah. I mean, so on paper, this share, I mean, it's almost like doubling of the current market cap. I mean, on paper at least. How was Citron result this morning? Yeah, again, the results, there were no details. They were just, the most important one was, of course, they announced a lot of potential LOIs, but the main one was the order book. Yeah. What are the real impact on the stock market with Trump admin coming on board? I think the main impact is going to be volatility, headline volatility, which I think could be actually good for SGX. I mean, if you talk about volatility, but the main impact is virtually Trump is going to short China first and then go and short Europe, because these are the two guys that he's targeting in terms of a trade war. So yeah, I think that's going to be the biggest impact, and the biggest winner is of course going to be Southeast Asia, because even in the UMS call they did mention that there are still some semiconductor components that are still being bought by the existing customer from China. There's no monetary value, but there is still sourcing from China. So I think you could come to a scenario people just remove China from the whole supply chain. Yeah. So that will benefit Southeast Asia. What's your view and any updates on First Resources? First Resources is going to announce the results on the 13th. So again, putting on my my Wilma hat, which the last call wasn't good. But we still think my plantations hat, which wasn't a good call. But we like it because we think palm oil prices is recovering, and also they will benefit, like you mentioned, from the excise duty. Yeah. For SATS reported good results, any reason for its share price performance due to Temasek recent unloading? Possibly, yeah. But fundamentally, nothing. There wasn't any red flags or anything. But I think someone mentioned that what is SATS exposure to potential trade wars between US and Europe, as well as EU, especially EU operations. Okay, so this is the scenario. I think a lot of people ask them that. I think I also asked them that. So firstly, they said the customers, it's only been 5 days. The customers haven't planned anything. But one scenario is that 30% of SATS business comes from the US. And none of it is domestic. Because domestic all do train, do railway. So most of it is their import and export into Australia, which the airport cargo which they handle. So the positive scenario is that if they switch out, if China don't take in, then they export out from Southeast Asia. Then Singapore, they still have a presence in Southeast Asia. So that's why for them critical to have a global network. From Europe, I think that could be an impact. So that could hurt their earnings maybe 10% or so, maybe. Because why we hesitate is that the clients will just divert it to other countries. So if they don't sell out of Europe, then the supply chain will move from other countries like Southeast Asia, Mexico, and all that. So, but I do agree that there should be some impact, but as an analyst, it's hard for us to quantify. So that's why we won't put it like we will mention it as a possible risk, but we don't really. The bigger risk is the volumes. So if there is a real trade war, then the whole total volumes come down because it will affect Singapore too. I mean, if the total global trade comes down, then cargo will come down. So that will be the big risk. Which we totally agree. Just that, as an analyst, it's hard to quantify that, because if you mention that as a risk, then everybody asks you, so what's the numbers? Like, how are we going to know what's the number? Yeah, the management also probably won't know. Yeah. Paul Genting, your views on the next 12 months and its target price. My expectations were, I thought they could actually fend it off. I actually thought they could outperform Marina Bay Sands because I thought their VIP won't be so big. But always remember, they might have a call because they don't invite us, to the call with analysts. But always remember, once you got one quarter, the earnings get hit from VIP, you're going to get it the next quarter, the next quarter. So the next 3 quarters is just going to be bad for Genting, because you're going to get this year-on-year thing, year-on-year impact on them. So it's already a sign that the VIPs are not spending on not gambling on this thing. So usually it won't stop at 1 quarter. This momentum will snowball for the next 3 quarters. So don't expect anything strong from Genting. It's not like they don't gamble this quarter, then next quarter suddenly everybody start to decide I want to gamble VIP. So usually there's a momentum and trend and all these things. So that's why I'll be very cautious on it. Yeah. Unless China economy suddenly spiked up and then a lot of VIPs decided they want to gamble on the VIP. Why I mentioned the VIP is because for Genting they got VIP and mass. So mass did well. Yeah. Okay, it's really 1 o'clock. Let me just answer these 2 last questions. Sorry everyone for taking so much time. Hi Paul, does it make sense now to buy venture purely for dividend yield? I think it does. I think at 6% yield after today's share price, it does, and earnings is starting to stabilize. It's not contracting the last 2 years. It's just that, again, as an analyst, sometimes if we try to upgrade it, then everyone will ask us, so when is the recovery, which we do not know. So if you do buy now, you just have to be patient that there will be a recovery, which they mention is coming from AI and license. It's just that we can't pinpoint. We do not know. We will probably be 1 quarter late, because once there is the turnaround, then when we upgrade, we will definitely be 1 quarter late, because we want to see the numbers start to turn before we upgrade. But investors who are patient can wait it out. But for as analysts, as you all know, we have the challenge. We can't just say, buy now, something will improve the next 12 months. And every quarter, every day, everybody will asking us when is the recovery. So we will be definitely slow. Let me answer this last one. What's your view on Hong Kong land in light of Trump's presidency? Like I said, Trump's presidency is like a shot on China and a shot of shorting China and shorting Hong Kong. He's basically shorting these 2 countries because of the 60% tariffs, which if it does happen, is a calamity. Not only jobs will be lost, the whole sentiment in China will just collapse. And of course, all this will flow to Hong Kong, which is really not doing well. Then you have this trade war, and then making it worse. Okay, I'm sorry we couldn't answer everyone. I was trying to type out some answers, so we'll try to end it now, and we'll try to post as much as we can some of those that the answers we can. Yeah, I know there's still like 16 questions we didn't answer, so I'm so sorry for that. Thanks everyone for your time, and apologize we couldn't answer everybody. Feel free to, I did send the links. Feel free to go to our Poland's website under events and register for any of the webinars that you find interesting. And with that, I'd like to thank everyone for your time and your questions. We hope everyone have a good week, and of course a prosperous week ahead. Thank you everybody, and take care.